Interesting to see Goldman Sachs coming out and of course, all of this right now and all the uncertainty is tied to the health front and whether or not we get a vaccine, where the case counts are going right now. But Goldman coming out and noting that investors might be overlooking the risk of a rotation here that could be sparked by a vaccine and what that could do for the rotation out of tech stocks into cyclical stocks. Of course, that's been something that you've noted a few times on this show. You've talked about those hard hit epicenter stocks. So what's your take, maybe them stealing your thunder here and talking about that rotation and how it could play out here in the back half of 2020?
Yes. Well, I mean, I think Goldman's bringing up a really important point, which is that, the way forward for coronavirus in the US and the world is not just, wearing masks and trying to eradicate the R naught to zero. It's that there can be some binary events. And, one of the biggest ones is going to be a cure or a vaccine. And let's face it, if we get a cure or vaccine, all the behavioral caution people have, the fact that they think, they're bunkered and not going to come out of their homes, that's all going to change. That's going to drive a violent rotation into the cyclical stocks, which we call epicenter. And epicenter stocks have gotten so cheap, they're almost as cheap as emerging market equities. And if you think about it, I mean, are US industrials deserving the same multiple as an EM cyclical? I mean, I think that's why epicenter has gotten ridiculously cheap. And so that's why it's violent.
Let's talk about those valuations too, though, because you talked about that last time you were on the show, specifically with tech, how they survived one of the worst economic downturns we've seen in our lifetimes, perhaps multiple lifetimes here when we think about the damage done. And they're still showing growth in terms of earnings. So, I mean, you talked about how it would be a reset in valuation there on the tech front. And just putting that into context, you look at PE and what's being ascribed here to bonds and high yield bonds there too, treasuries. I mean, put that into context for our viewers here when we think about why there might be more room to run on the valuations front when you look at it that way.
Yes. You're describing our work about how I think people are misplacing their fears about equity valuations, especially for the big cap tech. Number one, these companies are unkillable. I mean, they grew in the midst of a depression, and they're forecasted to grow earnings 30%. And they're trading at maybe 29, 30 times earnings. A 10-year bond, which has no growth, is trading at 180 times. An investment grade company, their bonds are trading at 52 times. Tech is a bond proxy. Is a bond proxy. They're trading at over 30 times. So I think tech equities as a bond proxy are super cheap. I think they're going to get re-rated because they are unkillable, and they're borrowing money at ridiculously low rates, so they deserve higher multiples.
Yeah, you talk about that. We saw Google come out with a $10 billion raise at its lowest ever borrowing cost there. The coupon rate of the $1 billion 5-year tranche was 0.45% there. Not that different than the yield we're seeing on the 5-year US Treasury at 0.22. So it just shows the ability for some of these tech giants to raise at incredibly low costs. But when you think about people know the FANG names, they know what the acronym stands for. But when we think about the epicenter stocks and you talk about the opportunity there and what these hard hit names could show in the recovery, you've named some retail names there, cruise lines in there, airline stocks have been in there, casino stocks in there. What names are you looking at in terms of where the opportunity might be if these are where the market will be rotating into?
Yeah, so something that we've been sort of, thinking out loud is there's a lot of businesses that are impaired now because people don't feel safe. Going to a theme park, going to a concert, getting on a plane, getting on a cruise, going to a casino. These are going to be binary events because unless you can substitute it, remember, we have generations of people taking planes. It's not like we're going to stop flying or stop, going to restaurants or getting on a cruise. So names like Carnival, Wynn, Delta, Disney, Six Flags, these are businesses that will come back in a ferocious way once we get a cure. And even something like Live Nation, which does concert promotion and ticketing. So I think investors can't ignore these things. Now, they're only 26% or so of the S&P, so it shouldn't be their whole portfolio. Mm-hmm. But at the end of the day, people are overweight growth, but they're going to want to own some of these if we get a cure.
Yeah, not to mention, I mean, you talk about Live Nation, one of those companies there that has been noted for having some pretty strong power in terms of control of the live events market. Dare I say, monopolistic power? I wouldn't go that far. But Tom Lee, when we also talk about the shift here, because some of these things have seen a noted shift to online. Obviously, you can't go online. I guess you could try and create the concert experience online. But when we think about other things, you've also highlighted research from McKinsey looking at how this shift to shopping online has impacted not just some of those things that we're used to, maybe things you might buy on Amazon, but beyond that, groceries being impacted by all this, household supplies. You noted a few different categories that might mark a shift. And it might remain to be seen here when we think about if all of those go to new players in Amazon, or if a Home Depot, for example, can shift some of those purchases that might be online from their store to online and still capture those dollars. But what's your take on how that might also be kind of the key element of 2020 and beyond?
Yeah, that's right. I think there's going to be a lot of creative destruction. And the creative destruction is things that consumers have changed now because of coronavirus that are going to be hard to reverse. And I think we've already discovered consumers now are doing a lot more online, whether it's grocery. Now they're doing ordering in instead of going to restaurants. They're doing more cooking. And I think some of the other things are like they're moving out of the cities. I think urban dwelling is going to suffer a semi-permanent change because people are seeking a practical way to sort of be safer. And so I think this is great for, as you said, for the work from home companies. It's great for housing related stuff like Tempur-Pedic or Home Depot. But it remains to be seen, how some of these restaurants can come back because, if they got a business model of in dining and they've got compliance issues now and people starting to order in and cook, it's going to be tough to come back. So I think there are businesses that are going to be left by the wayside. Part of creative destruction, though.
Yeah, and lastly, before we let you go, obviously we've seen a few analysts come out and raise higher their year-end price targets here. You've been talking about this before. A lot of that happened. So where are you thinking we might end up now as we sit pretty much back in the green here so far year to date?
Yes, one of the things that we've used as our framework is the idea that the market is symmetric. So the faster you fall, the faster your recovery. That's one reason we were so optimistic about a big bounce, because we fell so quickly. And we should be making new highs before September. I think given the unkillability and the fact that 75% of the S&P is growth and they're getting re-rated, I think the S&P easily takes out the all-time highs this year, and it's quite possible we see something much higher. But that being said, the future is uncertain, so I'm not going to say anything's guaranteed.
Fair enough. Well, I appreciate you coming back on anyways. As you can see, Tom Lee is in his car dealing with a few different things here on the East Coast after that storm, but I appreciate you taking the time to chat with us and making it happen, regardless of what nature throws at us. Tom Lee there, again, always appreciate you. Fundstrat Global Advisors, managing partner and head of research. Thanks again, my friend.